Now speaking, Chris Meade, General Counsel. Good morning everyone. I'm Chris Meade, the General Counsel of BlackRock. Today, I'm pleased to report that BlackRock had a strong quarter with record earnings and revenue. We saw growth in our core businesses, as well as in our new initiatives. Our total assets under management increased by 8% year over year, and our net income was up 11%. We also saw strong performance in our new products, such as our ETFs and alternative investments. We are confident that our strategy of diversifying our product offerings and expanding into new markets will continue to drive growth in the future. We remain committed to delivering value too. Now speaking, Martin Small, Chief Financial Officer. Good morning everyone. I'm pleased to present the second quarter of 2023 results for BlackRock. Our earnings release discloses both GAAP and as adjusted financial results, and I'll be focusing primarily on our as adjusted results. In the first half of 2023, BlackRock saw an industry-leading $190 billion of net inflows, resulting in $9.4 trillion in assets under management. This increase reflects strong organic growth and ongoing client confidence in BlackRock's work. Clients choose BlackRock for performance, and we deliver durable long-term investment performance through alpha opportunities, sourcing unique deals, and managing risk. We bring together the entire firm to combine investment technology and portfolio servicing capabilities to meet client-specific business needs. This is leading to clients consolidating more of their portfolios with BlackRock, and both first half and second quarter net inflows were positive across regions, client type, and active and index. In the second quarter, BlackRock generated total net inflows of $80 billion, representing 4% annualized organic asset growth and 2% annualized organic base fee growth. Revenue of $4.5 billion was 1% lower year over year, primarily driven by the impact of market movements on average AUM mix. Operating income of $1.7 billion was down 3% year over year, while earnings per share of $9.28 was up 26%, reflecting higher non-operating income compared to a year ago. Our as-adjusted tax rate for the second quarter was approximately 25%. Base fee and securities lending revenue of $3.6 billion was down 2% year over year and reflected the impact of underperformance on non-U.S. equity markets and fixed income market movements on our average AUM, partially offset by higher securities lending revenue. Performance fees of $118 million increased from a year ago, primarily reflecting higher revenue from illiquid alternatives. Technology services revenue was up 8% compared to a year ago, reflecting demand for Aladdin's broadening technology capabilities and the growing value proposition it represents for clients. Total expense was modestly lower year over year. Our second quarter as adjusted operating margin of 42.5% was down 120 basis points from a year ago, reflecting the negative impact of market movements on quarterly revenue. We repurchased $375 million worth of common shares in the second quarter and anticipate repurchasing at least $375 million of shares per quarter for the balance of the year. In May, we issued $1.25 billion of 10-year debt at a coupon of 4.75%. We expect to invest the proceeds of the offering at substantially the same rate as the cost of borrowing. Our ambition is to be the cloud of investment management and technology, and our platform strategy drove $80 billion of total net inflows in the second quarter. Broadening adoption of iShares ETFs fueled net inflows of $48 billion in the second quarter, led by fixed income ETF net inflows of $35 billion. Retail net inflows of $4 billion were led by strength in index SMAs through Aperio and broad-based net inflows into active fixed income. Institutional active net inflows of $9 billion included demand for customized LifePath target date mandates and illiquid alternatives. Private markets generated $3 billion of net inflows, representing 10% annualized organic asset growth. Cash management net inflows of $23 billion in the second quarter were led by U.S. government money market funds. We see significant opportunity to grow our market share and consolidate our position with clients as they choose to do more with BlackRock. We believe our platform strategy will continue to deliver for both our clients and shareholders, resulting in sustained, market-leading organic growth and differentiated operating leverage over time. Now speaking, Larry Fink, Chairman and Chief Executive Officer. We are the only firm that can provide a full suite of services, from asset management to technology, to help clients achieve their desired outcomes. We are the only firm that can bring together the entire firm as a platform to deliver client outcomes. That's the defining factor of BlackRock's differentiated and industry-leading leadership. Good morning and thank you for joining the call. BlackRock has been serving clients for many years, providing them with fiduciary services and evolving capabilities to help them achieve their long-term outcomes. We are building a sole platform strategy in asset management that brings together products, services, and technology to solve our clients' investment and technology needs. Our industry-leading results reflect our clients' continued confidence in our long-term performance. We generated $190 billion of total net inflows in the first half of 2023, including $80 billion in the second quarter. We grew technology services revenues and ACV as clients leveraged Aladdin to support their investment processes. We also delivered strong margin for our shareholders. Our scale, platform, and technology allows us to invest for future growth while maintaining a differentiated margin. Organic growth combined with positive markets and foreign exchange movements had led to an over $830 billion increase in BlackRock's AUM in the first 6 months of 2023. Clients are seeking a broad range of integrated services alongside a strong performance track record to help them achieve their desired outcomes. BlackRock captured the #1 share of ETF industry flows in the second quarter of 2023, generating $48 billion of net inflows. These industry-leading net inflows were led by a continued demand for iShares bond ETFs. We aim for our bond ETF AUM to more than triple to $2.5 trillion by 2030. Clients choose BlackRock for performance across multiple dimensions, including investment performance, client service, and operational excellence. Across our active franchise, BlackRock has delivered durable investment performance with 81% and 90% of our fundamental equities and taxable fixed income AUM above benchmark, or peer median, for the last 5 years. We saw $73 billion of active net inflows in the first half of 2023 compared to active industry outflows. We're also unlocking opportunities for clients in private markets, where we have $30 billion of committed capital. We recently announced our planned acquisition of Kreos Capital, a leading provider of venture debt financing in Europe. We are tapping into our deal flow across our private market asset classes and especially focusing on credit and infrastructure. We are investing early and staying invested through cycles, whether it's debt or equity, or a pre-IPO through post-IPO. We are engineering Aladdin for the future and expanding into adjacent offerings. We are creating deep integration with ecosystem providers and third-party technology solutions. Our success across a number of significant outsourced solutions over the past several years are catalyzing a dialogue with more and more clients. Second quarter results include a continued momentum in institutional and wealth outsourcing, particularly in family office models and SMAs. BlackRock is the only company that can offer both the portfolio investments and technology through eFront and Aladdin. We are the only firm that can bring together the entire firm as a platform to deliver client outcomes. Bank of America Merrill Lynch analyst Craig Siegenthaler inquired, "Do you expect money market funds and bond ETFs to remain the dominant drivers of flow? And do you believe most investors are waiting for the Fed to raise rates before making large bond reallocations?" Rob Capito replied, "Yes, yields are back and most people expect them to continue to rise. We're seeing a generational shift in the fixed income market, with 80% of all fixed income now yielding over 4%. This is a once-in-a-generation opportunity for investors to earn attractive yields without taking much duration or credit risk. We anticipate that bond ETFs will be used alongside our top-performing active offerings, and we have over 450 bond ETF choices. We also have the most diversified client base, including wealth advisors, active managers, insurance companies, pensions, and other institutions. We saw positive fixed income mutual fund flows in the quarter, with 90% of taxable fixed income AUM above the benchmark or peer median for the 5-year period. We had leading industry flows of $35 billion in the second quarter, and we believe we're well positioned to capture these opportunities. Morgan Stanley analyst Michael Cyprys inquired, "Could you please provide an update on your plans to double base fees in private markets over the next 5 years and discuss potential upside drivers, such as new products and scaling of existing strategies?" Martin Small replied, "Thanks, Michael. We've seen strong demand for alternatives from clients due to their need for income and uncorrelated returns in a higher inflation world with more volatile public equities. Our BlackRock Global Private Market Survey showed that over half of clients expect to increase their allocations to private markets and alternatives. We have a comprehensive platform with exposures across all liquid alternative asset classes, differentiated sourcing and access to high-quality opportunities, and the ability to integrate private markets investing with technology. Our platform is over $150 billion in private markets and we had 10% organic growth on a liquid in the second quarter. We anticipate adding nearly $2 billion of base and performance fees in 2022. We've raised over $85 billion of gross capital since 2021. We see upside in private credit and infrastructure, as banks potentially become more constrained in lending and investors seek higher yields in a low-interest rate environment. Government stimulus and tax incentives are also providing tailwinds for infrastructure. We're innovating in decarbonization, launching non-traded products across private credit, real estate debt, and 40 Act private equity into retail and wealth channels. We're also looking at how to integrate these products into model portfolios to build the portfolio of the future. Keefe, Bruyette & Woods analyst Michael Brown inquired, "What are BlackRock's plans for investing in the platform, people, tech, and capabilities in light of the increased AUM and equity markets?" Martin Small replied, "Thanks, Mike. Our industry-leading organic growth has been the result of disciplined investments made through market cycles. We have a strong track record of making good investments and delivering a differentiated operating margin of 42.5%. Over the last decade, we've expanded our as-adjusted margin by 240 basis points. In the first half of this year, we've seen an increase in AUM to $9.4 trillion. As markets recover, we expect revenue growth to outpace growth in discretionary expense items, driving accretive operating margin. We're investing for growth in the most efficient way possible, leveraging technology and systematized sourcing to drive scale. We have no change in our expense guidance and expect to finish the year broadly flat in headcount and with G&A up mid to high single digits. J.P. Morgan Chase & Company analyst Ken Worthington inquired, "Can you provide insight into the implications of the SEC's updated money market rules and the longer-term growth prospects for cash management?" Rob Capito replied, "We are supportive of efforts to improve the resiliency and transparency of U.S. money market funds. Our cash business is mainly comprised of U.S. government funds and separate accounts, with a diverse set of cash offerings including money market funds, separate accounts, and ETFs. We will work with our clients to determine the best liquidity management tools for them and review any regulatory rules that could impact our business. Cash management is an important business for us, as it provides performance and quality. We are optimistic and will continue to build our sales force to remain a leader in the cash management business, which will lead to other opportunities." Deutsche Bank analyst Brian Bettel inquired, "What timeline do you anticipate for significantly expanding your transition private markets portfolio?" Larry Fink replied, "Thanks for the question. Transition investing is a major opportunity worldwide, with governments focused on reducing their dependence on imported power. Through the U.S. IRA, we're seeing increased interest from U.S. and non-U.S. companies. We anticipate multi-year growth in this area, evidenced by our announcement of Acacia Energy, the world's largest battery storage capability. We're also having conversations with other countries about similar projects. We estimate the market opportunity to be in the tens of trillions of dollars. With many countries' debt-to-GDP ratios increasing, private capital will be needed to fund these projects. BlackRock is well positioned to take advantage of this opportunity, with our global platform, proprietary origination, and large sequestration projects like Navigator CO2. We're also working with corporations to help them decarbonize and expand, and co-investing with those who don't want to move forward. This is a multi-year global opportunity for BlackRock." Larry Fink replied, "Thank you for joining us this morning. I'm proud of the value we've delivered to our clients and shareholders. Our connected platform, leadership team, and collaboration will continue to drive differentiating growth. I want to thank you for being part of the call and wish everyone a great quarter and a pleasant summer."